afternoon, you're watching Bloomberg Quint Live. I'm Alex Matthew and these are the headlines at noon. It's strong trade on Dalal Street with both benchmark indices bouncing back after reporting their worst two-week losses in 2 years. All sectors gain except IT. Broader markets outperform. SBI is the top nifty loser after the largest public sector lender reported a quarterly loss for the first time in 17 years. The Singapore Stock Exchange says it's going to launch its own India products after the National Stock Exchange snaps the pact between the two. Hospital and medical chain operator Aster DM Healthcare is looking to raise 960 crore rupees from the primary markets. The IPO opens for subscription today. And now it's time for Hot Money.
Thanks for that, Alex. Of course, we're here in Hot Money, and this is in Bloomberg Quint Live, India's first digital live streaming business news service. And this is a show in which we get you a complete wrap of all the stocks which are buzzing in trade. I am Agam Vakil, filling in for Darshan Mehta. Let's welcome in our experts for the day. We have investment advisor Vivek Mavani, Kalra of Target Investing, as well as Sangeet Lakkar of Newberry Capital joining us. Thanks, guys, for joining me right now on the show. And today on the Hot Money, we will discuss SBI, Tata Steel, SAIL, and Indiabulls real estate. Let's start off with SBI. We've seen a substantial uptick in the stock. In fact, today, of course, we've seen a little bit of weakness. This is largely on account of the losses that we've seen. In fact, the first loss in 17 years, first quarterly loss, that is. Now, we have seen gross NPA divergence of a little over 23,200 crores, and your domestic NIMs, however, have seen a little bit of an improvement when it comes to sequential basis. NII again a tad lower than street expectations, but I think what was really bothering the street was that loss number that we saw for the quarter. That said, what is really interesting here for SBI is that when it comes to the Bloomberg consensus, we have 82% buys. That's 41 analysts on the Bloomberg consensus have a buy rating. And that's followed by just about 4 analysts with a sell rating. And the target price that the Bloomberg consensus has on SBI is around 366, which entails a 27% uptick from current market levels. So let's take the stock forward and discuss it with our experts. Vivek, you are neutral on the stock. How is your bearing on this particular counter, and what do you see?
Basically, to put things in perspective, valuations wise, it's quite okay. So, which is why I'm neutral. Otherwise, one has every reason to be bearish. And the whole story that that has been woven around the fact that the worst is over in terms of the PSU banks NPAs. That story, SBI numbers just blow a hole in that entire story. That worst is definitely not over, and there is probably some way to go before the bad loans issue gets actually resolved. That's number one. Number two, unlike any time in the past, this time was a double whammy in terms of also provisioning of almost 4,000 crores, 40 billion rupees in terms of mark to market on their investment and trading portfolio because of uptick in interest rates. Now, if I were to go back about 15 years, when last time we had a similar very large NPA problem between 2001 and 2003, all PSU banks were able to weather that impact on the balance sheet because there were huge profits on the investment and trading portfolio, the bond portfolio, because interest rates were on a downtrend. So the profits from the M2M profits helped mitigate the write-offs on the NPAs. This time, both the factors seem to be playing against the sector as a whole. I mean, SBI has got the largest stake in that game in that sense. So now the key monitorable going forward is what kind of provisionings on M2M for the trading and the investment portfolio because of rising interest rates, and number two, whether on the NPA front it's actually this is the worst that we have seen, or probably this continues for another couple of quarters. So from an investment point of view, I clearly see this as a no-go territory in that sense. Only thing that supports the view that I'm neutral on is that the valuations are pretty cheap. I mean, at about 0.8 to 0.85 or 0.9 times price to book, depending upon what kind of assumptions you take on forward earnings and forward next year's book value. But from a downside perspective, probably there isn't much, and hence you are neutral, but otherwise there's really no reason to buy it at this point of time.
Fair enough. So Vivek says there's no reason to buy it at this point in time for the reasons that he's mentioned. However, we have Sangeet, who is actually not too positive on the stock. So why don't you tell us about that, Sangeet?
So I agree completely with Vivek's points. I think he's covered the entire issue which we are facing of the NPAs. So it's the current NPA is more than 10%. Importantly, if you have been tracking this counter since so I've been hearing management commentary for last 4-5 years,
right.
And every quarter it's being said that the worst is over, we are at the bottom of the NPA cycle, and we had devised this fancy concept of price to adjusted book to value the PSU stocks, PSU banking stocks. Now, unfortunately, this adjustment to the book is happening every quarter.
Yes.
You never know where the adjustments or when the adjustments would come to an end. So I would rather wait to to see what that adjusted book is finally, to take any call on the counter.
Okay.
Strategically, we have to see whether anything in the underwriting has changed. So that we don't have NPAs going forward from the current loans which are been given. I have not seen any such changes as such in the PSU banking system. Other than government infusing funds, I don't think which kinds of is a hogwash to me. I would wait for some fundamentals change in the functioning of the banks per se. For me to turn positive on PSU banks per se.
Right. So okay, so Sangeet is saying that he's actually questioning when the adjustment is going to stop, and eventually we're going to start seeing some positivity with respect to at least that aspect. But Samir, how about you? You're also neutral on this one.
So I'm neutral to a little bullish on it.
Okay.
See, eventually the adjustment, as he's saying, last 4-5 years everyone's been hearing, that is accounted for. That's why even the valuations are cheaper.
Right.
Because eventually no one knows where the book lies and how the whole system lies up. My only plus point to SBI and the whole PSU system, it's being the reach. Now that reach advantage is giving them the benefit on the retail end of it. See, the main problem of NPA lies in the corporate books.
Right.
And if eventually it's not growing past 3 years, more than 9% or 8%, eventually that book goes out of the system. And if retail is growing at that faster space, then the NPA side of ahead might reduce. I'm not saying it might just wind up.
Right.
The only main issue in these two results was the bond yield increase, right? That had a 3,500 kind of crore loss to it. If you remove that, it was a 1,500 crore profit.
Right.
Right. So that is something out of control of SBI also.
Right.
Like every company who invested in GSEC in this quarter took that hit on the PAT itself. So SBI was not alone.
Right.
The only main difference came through the divergence. And out of that, only 12,000 is now taken as a bad loan in a certain sense. So even the management has talked about March. So I'm a little bullish as compared to other PSU banks, but as a whole system, I'm still neutral to look at certain things.
Right.
So, yeah.
All right. Okay. So you are okay. Fair enough. Sangeet, I just want a follow-up question. As Vivek has also mentioned that there may be, all the negatives may have largely been priced in, and that's something Samir is also saying. That said, that you actually have a bearish view on that, given the valuations, and they seem reasonable. You would still go ahead and sell something like an SBI?
Yes, because there is a concept called a value trap as well.
Right.
I think the PSU banks are a classic examples of value trap.
Right.
I don't think in next 5 years or 10 years down the line, the retail book per se as a percentage of total book is going to increase. If you see last 10 years, the private sector banks have captured the retail books from the public sector banks.
Right.
And I don't see that trend reversal to happen. So I don't see any reason to turn bullish on these banks.
Okay.
More importantly, from the NPAs, unless the NPA issue is resolved.
Right. Right. All right, so there you have it, guys. Two neutrals and one bearish position when it comes to State Bank of India, and this is contrary to what the consensus is going with respect to this particular PSU bank. Of course, these numbers can change, at least as far as the consensus is concerned. But with that, we'll move on to the next stock that we are tracking today, and that is Tata Steel, which did report a very strong set of earnings, at least for the December quarter, and its profit also jumped nearly fivefold. What we've also seen is the earnings improved, and which is better than estimates. But there's an improvement in realizations as well as deliveries contributed to the operational performance. And again, the Bloomberg consensus suggests that about 80% buys. Again, just 2 sells, that's 7%, and the 12-month price target standing at around 804 implies well over 10% increase from current market levels. So Sangeet, I'll start with you. You are relatively neutral. What's your view on Tata Steel?
So I'm neutral to positive in a way. So to play a commodity cycle, essentially you have to enter at the right time and exit at the right time.
All right.
So commodity cycle, I believe right now is just nearing its peak, if not the peak. Yes, the domestic demand is looking very strong. Tata Steel obviously is not only the domestic play, it has the global play also. In terms of valuation, it's trading at about 7.5 times EV to EBITDA, which is not so cheap. So if you see the historic valuation of the commodity or the steel companies, it's trading at a higher end of the long-term average.
Absolutely right.
So just because of the valuation, I think I'm a little neutral, so to say. The business is doing fairly okay. If you compare to the other steel companies. So yeah, that's where we are.
All right, Sameer, how about you?
So I'm neutral to bearish on Tata Steel. 2 reasons. See, what has happened, they're sending the Europe venture into the JV.
Right.
So that reduces the debt, right?
Okay.
On the domestic operations, they're doing really well. Within this result also, that showed that the costs have rationalized, and there eventually that reduction in interest costs has actually benefited the PAT.
Right.
So that being said, now they had around 23,000 crores planned for next 4 years as capex, for the domestic part. Now what is happening, all these stressed steel assets which are there like Bhushan and others, now all these firms are eyeing for them. Now the only point is it's getting aggressive in the bidding part also. Like Bhushan Steel was being bid at, has a stressed asset value of 15,000, it's been bid at 44,000.
Right.
Now that is like 3 times, right? And eventually I front load my capex in a certain sense.
Yes.
So I have to take that huge amount of debt, because see, eventually commodity doesn't have a technological benefit. It's only how much resources you control leads to how much market share you'll have in the market. So it's a continuous capex cycle which needs to be done, and if you go slower, you have this phase of losing out on the up cycle, right? So that fear keeps everyone putting more money, more debt, and creating much more heavy balance sheets. And see, eventually prices may be up today, tomorrow they be down, but then I cannot have a long-term investment which is more driven on the global and out of the source of macro, and which doesn't have a technological benefit.
Right. So Vivek, would you like to counter some of points that Sameer's made, because you are neutral to positive, if I'm not mistaken?
A couple of things. One is the delivery of results which positively surprised the street were largely to do with higher price realizations as far as the domestic business is concerned. So better profitability on the domestic business more than made up for the weakness on the European business. Hopefully, as far as the European business is concerned, hopefully I'm using the word that the worst is over in terms of whatever pain they had to take, which they have been, that it's been the pain point for Tata Steel for the last 5-6 years, and hopefully now it's the end of the pain. Now, all of this depends on steel prices, which are now at elevated levels, continuing to stay at elevated levels on only 2 factors. One is the global economic growth also being at higher levels and fairly optimistic projections going forward. And on as far as steel is concerned, little restricted supply from China. So that the dampening factor in terms of China's volume coming into the global market will probably keep prices at higher levels. So these are the only two positives, both of which are actually beyond the control of the concerned management, whether it's Tata Steel or anybody, as a matter of fact. Right. Now, from the valuations point of view, it's at the, as Sangeet mentioned, it's on the higher end of the multiple range, range of multiples that it has traded any time in the last 15 years or so. Right. So the risk always remains that if global steel prices correct, maybe the stock will derate. I mean, the sense multiples itself will shrink. But so long as the steel prices remain at elevated levels, I think the higher multiple at 7, 8 times, or maybe in a bull market can also go to 10 times. There's a possibility. From an investment point of view, because we can't time the commodity prices, how long will this cycle continue? The uptrend in steel prices continue? Well, anybody's guess is as good as any second person's guess. I mean, nobody really knows. So hence, I would say it's only a trading stock where you participate, you buy the declines and you sell the rallies, and hopefully you make like 8, 10 or 10, 15%. Hopefully you make in or each trade maybe a couple of times a year, you keep doing that. Besides that, from an investment point of view, at this point, at these levels and at this point of time in the cycle, I mean, investment again is a no-go area.
All right. You know, Samir, you did mention a lot of concerns with respect to Tata Steel. Then I would ask, why remain neutral? Why not turn bearish completely?
See, again, that's what I'm saying. So, as an investment perspective, I'm bearish. But see, eventually what happens if you turn bearish to a certain commodity, right? And eventually prices are not over your control, right? If there is a certain, see, now if people talk that China capacity is going out, then even the Europe business should do well, because we are talking about the global supply, right? And they already have the global player which has a good capacity on their hand. Right. So that is nowhere reviving somewhere. But the only point is that optimistic of other investor keeps it elevated. Right. So, and the only point is maybe certain places as an analysis you might go wrong. So you really don't want to have a strict point on the commodity side.
All right, fair enough. So, well, that's the view on Tata Steel. On the whole, again, we have largely contrarian views with respect to consensus. So, and it's an interesting stock too. But we'll stay with the steel sector. And the next stock that I want to address is SAIL, because we've seen about a 16% uptick in just the last 3 sessions. Well, perception is that the fundamentals of the company seem to be improving, and again we have 6 out of the 8 plants as per the latest reported numbers where the losses have been narrowed on a year-on-year basis as well as a quarter-on-quarter basis. The other positive, of course, is that, as a lot of analysts are putting, is that it's reaching the end of its 62,000 crore capex cycle that it's carried out over the last entire decade. Now, can this have a positive? Well, let's find out. So, Vivek, I'll come back to you on this one. You're neutral to positive, if I'm not mistaken, on this one.
Yeah, so basically, in the sense, like there's a saying, a rising tide lifts all boats. And SAIL seemed to be the worst boat as far as steel companies were concerned. I mean, I'm assuming you're not including Bhushan and SR in the same category. But in terms of operations, so even when most other steel companies were profitable, SAIL was not. And as your previous graphic in the previous screen pointed out, I mean, it's after some 9 quarters that SAIL has come back to profitability, only and only because of higher steel prices. The positive, or the 2 other positives, one was the slightly higher than estimated volume that they did dispatched, and a slightly better cost structure. Now, whether the cost structure is going to sustain, again, one really doesn't know, being a PSU. That's number 1. And number 2, the steel cycle which we discussed about Tata Steel, I mean, one really doesn't know where and how long can this cycle of elevated prices continue, or whether they will continue to go even higher. Right. Now, assuming a steel cycle does go higher, there are better plays available than a steel authority. If the cycle does not sustain anytime soon, then there's absolutely no reason to be into SAIL, because quite likely SAIL will get back to losses. So, I mean, as you mentioned, that 6 out of the 8 plants reported better performance. Probably it may just turn, I mean, it may just reverse in another 2 quarters if steel prices don't sustain at higher levels. So now, do I need to stick my neck out on too many variables, too many ifs and buts, which are not only beyond the control of the management of SAIL, but more so beyond even the imagination and thought process of an investor? So being a commodity investment is anyway out of cycle. If I need to play the commodity cycle, then maybe a JSW Steel is something even better, where at least there are operational efficiencies which drive that, and they have a certain amount of fixed margins that they make per ton, even in whether the steel cycle is on a downtrend or an uptrend. So in that sense, an operating model of a JSW Steel will be much better than a Steel Authority wherever the cycle goes.
Fair enough. So you're suggesting that it's not a bad position to be in, but there are better plays and there are better opportunities than Steel Authority. Sangeet, you're of course not viewing the stock positively at all.
Yes. So again, I think it's a classic example of a debt trap or a value trap.
Right, yes.
It's trading at one-time book, which looks very, very cheap. But as Vivek pointed out, the last results which they have reported is purely account of the price, the steel price rise.
Okay. Right.
One aspect which works to their advantage is they are an integrated player. So what happens in an integrated player is since they have their captive mines,
yes,
when iron ore prices increases, it benefits more to SAIL than to JSW, because they have to buy iron ore, So that works to their advantage. Having said that, if you compare the efficiencies, because essentially it's a commodity play, and the most important aspect in a commodity play you'll have to evaluate is the cost structures, because the lowest cost producer will ultimately sustain. Now, if you compare the cost structures, the employee cost or the employee efficiency for SAIL is about 165 tons.
Right.
Whereas if you compare to something like a JSW, it's about 1,000 tons.
Right.
That itself explains the rationale for not being positive on such a company.
Okay.
So yep,
All right. So that's the view on SAIL. Sameer, how about you? What are you doing?
So I'm same as Tata Steel, neutral to bearish.
Okay.
Given the positive on the the cycle of the steel, but if you see management has promised a 10% volume growth year on year from 2017. This year they are doing 9 months around 7%. So they're able to achieve that kind of volume growth because of the heavy capex which they did in the past decade.
Right.
So, but the only point is, again, as a commodity driven cycle, if tomorrow the prices go down by 10 to 15% also, that all capex which they have done or the whole costs are fixed. See, eventually in manufacturing you have a lot of fixed costs rather than the variable costs. So whenever your pricing power goes out of play, your books get battered very badly. Right. So that's why we don't think commodities is a place to be invested unless it's a totally debt-free kind of operation being run like a Hindustan Zinc.
All right.
So again, SAIL, I'm neutral to bearish.
Fair enough. So that's the view coming in for SAIL. Again, we have neutral to bearish, views when it comes to this particular stock, despite the fact that we've seen a little bit of improvement, but we haven't really seen consistency, and that eventually may determine whether or not, a lot of our experts may eventually become positive on this particular stock. But let's end the show with, one stock which has been buzzing on some development with respect to restructuring of its commercial and residential businesses. That's Indiabulls Real Estate. The stock has, as a matter of fact, gain as much as 20% in the last 3 odd sessions, and again we will have the board meeting on Wednesday where there will be some decisions taken with whether or not we could see some demergers or restructuring of its businesses as a whole. So let me start off with you, Sangeet. How are you viewing the stock right now, and what will this development mean for the counter two?
So I'm neutral to the stock. The concern which I have is obviously there are certain managements in this market where you don't wish to back on.
Right.
Possibly this qualifies under that criteria. However, if you see the isolated business, the valuation looks quite promising. If you see the rental business itself, it generates about 720 crores rental income, which will go up to about 1500 crores by FY20 with the 6 commercial projects coming on stream. Which essentially explains the current market cap of the company.
Right.
In addition, you have small value coming from the residential unsold inventory which is there. It's about 15,000 crores, but against that you have a debt of about 5,000 crores odd, and there's a construction cost to be incurred of about 6,000 crores. Plus you have a land bank of about 1,000 acres spread across Mumbai, Chennai and NCR. In addition, there is a huge land bank at the Nashik SEZ. So in terms of value, it's a good value proposition. My only concern remains on the management quality.
Okay.
So that's why I'm neutral to the stock.
All right. Well, management, of course, is a very crucial factor, especially when it comes to real estate companies. Sameer, how about you? What is your view?
So I'm neutral to bearish on it, given two reasons. If you see the annuity of the commercial part of them,
Right.
they earn around 720 crores FY18. They're projected to make it 1513 crores FY 2021.
Right.
And right now, whatever the news related system has come in, that's Blackstone giving them a $500 million kind of a for that stake, whatever that valuation is. So that will only reduce the debt by around 3,000 crores, even if in that system comes up. See, residential, I see a very high leverage play. Commercial still yields you an annuity, so you're more better off over there.
Right.
If they list it separately in the future, then I might look at it in a positive way.
Right.
But as a whole system, I'm much more bearish on it.
Okay. Vivek, I know that you don't have coverage on this stock, but if I were to ask you about the real estate sector as a whole, we've seen a lot of ups and downs in the recent correction that we saw. I just like your view in general when it comes to real estate stocks, and if there are any other stocks that you may like or completely dislike and that you'd advise our viewers to, not venture into.
A couple of things. The reason I don't track or have a view on Indiabulls is precisely the management aspect, which Sangeet mentioned, and I absolutely. So even if there is a lot of value, there may be value. I have not evaluated it, but even if there is value, assuming, I wouldn't really bank on this management to deliver that value to me as an investor. However, what is happening in the real estate post the demonetization, post the RERA, and whole lot of you could say suppressed prices for the last 3 to 4 years, where real estate prices haven't gone up and there's huge amount of unsold inventory. What has shifted in the segment is or the sector is that consumers or the buyers now prefer large, established, well-known companies which are known to deliver projects on time, deliver on specifications promised at the time of launch of the project, and so on and so forth. So that's where Godrej or Mahindra Realty, I mean, those kind of companies stand out. They have been growing faster than a whole lot of others. They seem to have less number of problems either on the balance sheet or on unsold inventories and launching of new projects and all of that. So if I have to bet on that, at least a management comfort I have with a Mahindra and a Godrej. And I don't really, firstly, I don't really think that the sector is good for investment at this point of time. But if I have to at any point of time take a call, I mean, these are the two companies I'll look at.
Right, right. Okay, so Vivek is largely cautious when it comes to the sector. Of course, when it comes to Sameer and Sangeet, they are again well neutral on Indiabulls real estate. But with that, we've run out of time, so it's a wrap on this edition of Hot Money. Up next is Ask PQ, so stay tuned in a Bloomberg Quint, and I'd like to thank you all of you for joining us and giving us your views. So stay tuned.